Raheja joining us of Julius Baer India. Of course, Nagaraj still continues to be with us. Nagaraj, some of the jewelry names, right? Nitin, I'll come to you in just a minute. Please bear with me. Some of the jewelry stocks, right? Nagaraj, you've seen some very decent traction in recent weeks on some of those names, Kalyan and the like. What next, and any favorites within that? Also, this 10% downtick on Thangamayal, not looking pretty.
Thangamayal is not looking that great. It has had a good run and showing some decent downward correction from the higher levels. On the other hand, Kalyan Jewellers has showed some minor decline, minor downward correction, and bounced back very well from the lower levels. The overall chart pattern of the Kalyan Jewellers is looking very strong at this point of time. Though placed at the higher levels, still there is no indication of any reversal building up. I think this is likely to move up further for this stock prices.
Okay. All right. Nagaraj, thank you so much for joining us, giving us your views this afternoon. Nitin, hi, great having you. Let me start off with ideas. What is it that you're looking at afresh at this point in time? You've seen a significant rally in IT stocks since the last time we spoke. How is it looking?
I think what you're really seeing in IT stocks is some amount of sector rotation that has happened. I think it's too early to call it, because if you look at the commentary that has come out with most IT companies, the path ahead is not very clear. But clearly, I mean, from a multiple of 21, 22 times, they're down to 14, 15 times. They have dividend yields of 4 or 5%. So I think we are seeing, and as question marks on the whole AI CapEx trade unfold, you are seeing some amount of sector rotation or sympathetic buying that is taking place in IT services companies. Our own view is that, look, there is some element of value buying which will happen, but for it to sustain, I think IT companies yet the path ahead is not very clear. So I think we will see this more as a short-term tactical trade.
Okay. Do you play the trade now, Nitin, if you haven't already played it?
So, we are, in our portfolios, we are actually taking an equal weight position. We are not really going overweight on that. And a lot of the trades that we normally play are long-term strategic themes. So, from a tactical perspective, we are just equal weight on it.
Okay, equal weight. Remain sanguine. Should one play auto at a time like this? You've seen a decent run-up. It's very stock specific. I know you were bullish on Hero, for example, towards the latter half of last week. That has played out decently well, but what next?
See, I think now a major part of the rally, at least the initial rally, is behind for the auto names, because what has happened for the auto index is there was this gap from the month of March, when the war actually started off. And that gap for the auto index was around 28,000 levels. Now, today, in the process of the auto index hitting that 28,000 mark, we've actually filled the gap completely. So, which means that we could probably be in for some bit of a mild cool-off or a correction for these auto stocks, or a consolidation for the next couple of days. So, for someone who's looking at it as a short-term time frame and wants to time the entry, I think it's better to just wait for a couple of days, because I would sense that maybe there could be a stock-specific cool-off which could happen into the auto pack, and that could throw in a good opportunity. And in case of these auto stocks, say, drop in somewhere around 4-5% from their recent swing highs, 2-day, 3-day swing highs, then I think it's a good price territory to try and enter into these names.
Okay. Nitin, I wonder, how do you look at auto? And, I'll just quickly highlight a couple of numbers before I come to you, Nitin. Craftsman Automation, record top line, record EBITDA, record PAT quarterly, and you've seen very strong growth Q1. You've also seen that EBITDA margins have held up despite the kind of growth that they've seen. I'll quickly pull out the numbers in just a minute, but Craftsman was one of them. There's also Car Trade, which is more of a platform play, but that one also came out with numbers. Nitin, Auto Ank, two-wheeler, four-wheeler, CV, how should one play? Nitin, I believe you're on mute. No worries. No worries.
So we like the entire pack. we have an overweight position on them. We think the auto sector, in the beginning of the year, once the West Asia crisis started, actually corrected. If you see a lot of the auto players, some of them are down anywhere from 15 to 20%, the OEMs, especially within the passenger vehicle segment. I think they present an opportunity because volumes have been strong. So whether it's two-wheelers, in fact, two-wheelers, we've seen, we like the players who are much more diversified, who, beyond India also have a global play. We like the EV players within that pack. And, from an auto angle perspective, I think these companies have been diversifying their product basket. They've been increasing the TAM, and they've been going beyond India. So as a whole, we like the sector and we like to be overweight in this sector.
Okay, the other one, Nitin, that really stood out between yesterday and today is consumption. HUL, that initial knock of 7%, and thereafter the rebound this morning, and nothing's changed per se. I mean, the numbers and all remain the same. But you believe that was a bit overdone, and how are you looking at consumption? Just give us a sense while we speak about auto. How does consumption look?
This has not been individual to a particular stock. One of the very interesting trends that I have been noticing throughout this result season has been this fact that on result day, whenever the results have been declared, the stocks are down. And immediately after that, in the next few days, you also see a recovery. And this is not with respect to one stock. We have been seeing this sort of a pretty unique pattern in this result season with this across sectors, whether it's been IT, whether it was with respect to some of the consumption names that you talked about, and so on and so forth. So it just seems like and stocks which have actually been beaten down prior to the results have actually seen a sort of a sympathetic bounce back. So it's in pattern with the overall market, which is trading in a range. So you have this market which seems to be going up, going down, but it's within a range. And I think some of these stocks are following through on that. Because if you look at the results purpose of a lot of these companies, especially in the consumption space, and today we've had one of the retail play, it's the same pattern. The results are not really bad. It's just, a sort of a stock reaction that takes place or a sell-off that takes place on that particular day with a quick bounce back over the next few days.
And also, I want to try and weave in your view also on some of these QSR names. There's so much focus. Mrs. Bector is being bought by a mutual fund, marquee mutual fund of sorts. Thereafter, you had this entire buzz on the stock. Today also, you had Devyani International's numbers, very, very strong set. Is this under-owned, underappreciated kind of a pocket, you believe, Nitin, QSR?
I think there is a comeback in the QSR sector that we are seeing initial signs of. This was a very, very highly fancied sector, if you remember, a few years back. And then you had slowing growth and high valuations catch up with the sector. And we've really seen a huge consolidation in terms of prices, in terms of valuations over the last 2 or 3 years. If you read the commentary that some of them put out in the annual report and also in their results, they've all talked about a comeback in terms of same store growth or volume-led growth. So I think that sector is considerably overowned, and the market is looking for sectors which have consolidated and where there is an initial sign of growth, and you are seeing that rotation happening. It's early days, mind you, as a word of caution, and valuations are not the cheapest yet in this sector despite the correction. But clearly, I think we are seeing interest levels flow back.
I'll take a cue from what you said in your previous answer, Nitin. Try and quiz Kunal. Kunal, I'm going to just throw some stocks at you. Give us a sense as to whether you should buy the dip on some of these, because some of these are really beaten on the back of earnings today. There's a PNG, for example, down 4%, which I believe, Nitin, you were referring to. There's Reflex Industries, there's Sharda Cropchem, which is down 6, and there's Thangamel, which is down 10. And any of these at all looking good to buy today, probably hoping for a bounce maybe tomorrow, buy today, sell tomorrow types?
Not really. It doesn't look like, because I think Thangamer, for example, is at a lower circuit since the I think since noon approximately. So which means that there could be a possibility that the stock may see a further cool off tomorrow. For the other name which you mentioned, Rifex, also I think on the short-term charts, you're looking at the stock going through some bit of a pain. PNG Healthcare, I think that's also another stock which has now made a fresh 52-week low or maybe a multi-month low at the current price level. So the chart patterns are not attractive to calling for a buy. We go in for a buy or buy on dips into stocks where the erstwhile trend has been very positive, and when these stocks generally are on the verge of an ending phase of correcting or a mean retracement or a mean reversion. That's where a better trend or a contra buy originates. So far, doesn't look like for the names which you mentioned.
Okay. Also, platform companies, Kunal, Swiggy, Zomato, Swiggy's moves last couple of days. I mean, it's such a sharp move. I mean, how quickly the market changes, right? Both in terms of sentiment as well as in terms of the moves itself. But give us a sense on this one, on charts.
But Swiggy has traditionally been a very high beta stock. Now you compare Swiggy with Eternal, Swiggy's beta or the average true range, which is a statistical measure which we look out for, is tad bit more as compared to Eternal, especially in terms of the volatility. And that's why I think Swiggy generally has this effect that whenever the stock goes into a breakout, it shows those initial signs of a breakout, suddenly goes through a correction, and then gets ready for the second round of a up move in terms of a breakout. So I think that second round of up move now for Swiggy seems to have started off. It's good to see, I think, Eternal holding on to the 300 plus levels. So this should bode good confidence across the sector as such. I would believe that Swiggy over the near term could probably head towards at least the 310 to 325 levels over the very near term, say potentially over the next 3 to 4 weeks.
310 to 325, so plenty of upside left here. All right, and that's the take coming in on Swiggy. So it's Swiggy over Eternal at this point of time, right, Kunal?
Yeah, so I think as a fresh trade,
Yes.
Swiggy is a better one, but I think
Right.
Eternal is something which I've been bullish on earlier.
Wow, okay. Perfect. All right. So that's how we're set up. Platform companies, Nitin, are you favoring any of them? Are you liking any of them? Swiggy, Eternal, even the Car Trade, which came out with a decent set of numbers today. Stock is down maybe 3-4%, but the kind of run up on Car Trade, I mean, it was a 300 rupee stock not too many years ago, maybe a couple of years ago, currently sitting at 3,000 a piece.
I think it's more, if you look at these platform companies, the key element out there is the fact that the competitive intensity that was being factored in and had resulted in a correction in prices of the company, especially in the quick commerce space, given the fact that the incumbent challenger is struggling with its valuations and fundraise, and the leader has actually moved to a path to profitability, is starting to see the fact that the fears of the competitive intensity were while being there were higher than what has transpired on the ground, and hence you're seeing a return of interest in these businesses. We like the space, and we are positive on that.
Okay, all right. We'll swim in a very short break. Come back. Very engaging conversation. Plenty.
At this moment, the planet is waking up. It is happening now. And all of it needs energy to work. One good thing lighting up another. People getting curious. Not afraid to imagine big. Oceans getting a chance to recover. Kids dreaming like kids should dream. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Wow, so you use this trading app too?
Yes, because it promises guaranteed returns.
Guaranteed returns. Your trading app is authentic, right? Here's the catch. First, they promise guaranteed high returns with a grin, then trick you to download a fake app and pull you in. Well said! Well said! SEBI and NSE advise. Download apps only from the verified apps list on SEBI's investor site.
NSE द्वारा निवेशकों के हित में जारी.
Dear bestie, how can I thank you for those long, tight, it will be alright hugs, for those unladylike laughter sessions, for healing me? How can I thank you? They say the truest friendships cannot be manufactured. They simply unfold naturally. How true that is. Bestie. Love from Bestie Collection. Natural diamond bracelets for you and your bestie.
Manipal Health Enterprises Limited launches an initial public offer of equity shares of face value of 2 rupees each in the price band of 560 to 590 rupees per equity share. Bid/offer opens on Wednesday, July 29th, 2026. Closes on Friday, July 31st, 2026. For risk factors and other details, please refer to the Red Herring Prospectus dated July 23rd, 2026. Available on the websites of the SEBI, the stock exchanges, the book running lead managers, and the company.
Welcome back, and plenty to talk about. KPIT Tech being one of them. The stock has surged on the back of the Q1 numbers. Margin pressure, though. Darshita here to break down the numbers for us.
Right, KPIT Tech had already prepared the street for the weak quarter. In its business update release, the company said that they are guiding for 1% decline in the US dollar revenue due to the project-related headwinds. However, the actual results offer a small positive surprise. US dollar revenue declined by only 0.6%, which is better than the company's own guidance, with the management stating that the Q1 performance came in slightly ahead of the outlook shared earlier. Now, that said, the overall quarter remained weak. While the revenue were broadly in line with the expectations, the EBITDA, EBIT and the PAT missed the estimates, with margins coming under pressure because of the lower revenue and an unfavorable business mix. Now, looking ahead, management remains optimistic. It says that the deal pipeline continues to be healthy, particularly in the product and solution business, and expects stronger growth in the second half of FY27. Now, on the margins as well, the company believes that the profitability will improve sequentially every quarter, supported by better revenue mix, business growth and the AI-led productivity gains. So while the Q1 was a weak quarter financially, the focus now shifts to whether KPIT can deliver its H2 growth and margin recovery as promised.
All right, so that's with regard to KPIT. Let's quickly take a chart check on this one. Kunal, KPIT Tech on charts.
So it's still not one of the strongest name on the IT pack, but then it's started to show signs of recovery. There has been a huge gap resistance for KPIT Tech, right from the likes of 670 falling down towards almost 600. So it's now managed to enter into this gap territory, but it's still yet to break past about those 670 levels as a barrier. Today's high, for example, for KPIT Tech is 662. So we need to see a stronger evidence of a breakout of the 670 or maybe a 675 breakout for KPIT Tech. This could determine a potential change in prospects for the stock in the near to medium term.
Okay. Any of the ER&D plays, is that a space you would venture in, Nitin? Because you're not exactly overweight IT. You're in fact just about equal weight, it seems. Would ER&D be something that you would fancy?
At the present moment, no. We most of our weightage is towards the larger names in the sector because of the sheer correction that they've seen, and in some of the mid-cap names.
All right. Okay, so that's the tilt. Nitin, what else are you liking in a market like this? What is looking opportunistically good? Maybe not immediately, but from a medium-term perspective.
I think what you're also seeing is with the global sell-off in the whole AI CapEx trade, you're seeing a correction in some of the companies in that segment. If you look at it on a month-to-date basis, a lot of the companies in the power ecosystem have corrected, close to anywhere between 10, 12% to even 20%. I think this is a longer term play. India has just started the whole data center CapEx story. So I think you will see opportunities and growth coming there. And this correction could actually, be a good time to start looking at some of the stocks out there. We continue to like consumption and more so premiumization of consumption. Whether it's consumption services, which includes hospitality, aviation, and so on and so forth, which should continue to do well as such. And of course, there is the whole private banks who have actually seen a sell-off post their results. We think the valuations, some of these banks with 15% return on equity are growing their books and are trading at, have come down to price to books which are historical lows. I think clearly we like some of those stories.
Okay. All right. Private sector banks in particular, do you like the larger ones, Nitin? Would you venture down the market cap curve to look for opportunities where there could be a large re-rating in terms of ROA for FY27?
We like both. We think we would have a mix of both.
Understood. What about mid-cap banks? Where there's been plenty of chop and churn in terms of promoter ownership or top management. The likes of RBL, Federal, and the like. Would you even IDFC First for that matter? No change there, but broadly there's plenty moving in around that. So banking as a whole, Nitin.
Yeah, so we think that look, the worst is behind for most banks. Which is, with nominal GDP expected to be in double digits this year, credit growth expected to go back to anywhere around 14 to 15%. The interest rate down cycle over and behind. We clearly see that, and plus adequate liquidity in the system. We see, I think banks have, a good headroom to grow. And, we sort of like the entire sector. But of course, we would pick and choose banks. Between some in the large cap, some of the second tier ones, who have actually, by the way, done very well in this quarter and delivered some very, very strong numbers. So we would probably play across on a bottom-up basis.
Banks, Kunal, I know that you don't fancy them, but could things change just given the kind of momentum that's building up in the market, at least today, which is visible?
Too early to say that, Harsh, because I think it's just one of days where you see the Bank Nifty showing signs of slight bit participation. But even with this 400-point uptake for the Bank Nifty, it's been a slight underperformer with respect to the benchmark indices, where you're seeing the Nifty up 1% plus. The Bank Nifty is up just about 0.7, 0.8 approximately. So that tells you that even though the performance is on the upside, but it's still a tad bit on the lower side when you try and compare this with respect to the benchmark indices. The bigger concern for the banking names is the immediate reprieve which you are unable to see for those large cap heavyweight banking stocks. And I'm not just including the private sector banking names, even the PSU banking major like SBI, for example. The fact that these stocks are unable to lift off to any kind of a big breakout, see signs of trend, durable recovery for themselves, makes the rally in the Bank Nifty a little bit more questionable. The second, the more important part is that even after this 400-point rally today, the Bank Nifty has been unable to surpass above its 200-day moving average. So this could also be a big question mark that maybe over the near term, the trend for the Bank Nifty could improve once we break past about those long-term averages, which till now it hasn't.
Okay, all right, that's on the Bank Nifty. But M&M will be expected to come out with quarterly numbers tomorrow. Let's quickly go across to Avi. He's here with what to expect.
So Mahindra & Mahindra is going to come out with the Q1 FY27 numbers, and let's have a look at what we are estimating at DT now. We are estimating the revenues to rise by 23% on a yearly basis, coming in at 41,762 crore rupees, and the EBITDA to rise by 9%, while the profitability, which is the PAT to rise at around 3%, coming in at 3562 crore rupees. What is important to look at is the margins that M&M comes out with, as we are estimating around 1.5% of margin contraction at 12.8%, down from 14.3% last year. So margin is something that we would be looking out for. The volumes are expected to be good, coming in at 4,40,000 units for the quarter gone by. So what are the factors at play for Q1 FY27? This volume growth has been very good for the auto segment as well, being driven by the exports, SUVs and the CV segment, while for the tractor segment the volumes have also been very good. The company has taken price hikes which have been able to partially offset the commodity cost inflation that the OEM is facing because of the West Asia crisis. The margins is something that we would be looking out for, and what is the kind of commodity cost inflation impact that has been on the margins. But the higher EV mix that Mahindra has is also weighing on the margins. So some of the key things to look out for in the earnings for Mahindra will be the demand outlook, both for the auto and tractor segment, the margins impact that comes out for the published numbers because of the commodity cost inflation, the new product launching timelines, at what timelines will the new product launches will come, and the volume guidance that they give for both their auto and tractor segment. So all in all, we expect a decent set of numbers from Mahindra with good volume growth, but something to look out for will be the margins in the Q1 segment.
Okay, thank you so much for that, Avi. In fact, Sirma's numbers have just come in. I'm going to quickly try and pull those numbers out. Sequentially, the EBITDA is slightly softer, but typically you look at this YOY, right? And therefore, you've seen very, very strong numbers. Those numbers will just come up on the screen in just a few minutes from now. But essentially, it's very strong growth on the top line, along with decent margins, which is coming our way with regard to Sirma SGS. Margins on a year-on-year basis, last quarter, Q1 was at 9%. Currently, margins are above that 9% number for Q1 FY27. Q1 FY26, I beg your pardon, was 9%. Q1 FY27 is higher than that. So margins have gotten better. We'll keep track of that, of course. Closing minutes, though, of trade. Quick final thoughts. Nitin, outside of private sector banks, anything that's looking interesting to you?
Well, I think we mentioned about the fact that, right, we like the whole CapEx, power CapEx play, which is corrected. Besides the banks, also we like the consumption plays within the economy. We think those are, and of course, we like EMS as a sector. We think that's another sector that one can look for long-term plays.
Numbers. Nitin, I just want to prod you further with regard to CapEx, because two things have stood out for me this quarter. One is your private sector banks. They have suggested that wholesale lending has picked up in a very solid fashion this quarter. At least that's what is evident. The second thing is the fact that L&T said that private sector CapEx related orders have been strong. How do you play this theme, Nitin, in your opinion?
Well, I think you could play it through the EPC companies. You could play it through power transmission sectors. You could play it through the electric equipment companies. I think these are some of the plays that one can look at.
Okay, Nitin, thank you so much for those thoughts. We'll let you go. Thanks so much for coming in and giving us your view.